Imagine this scenario. You've been driving for 30 years. Clean record. You trust your hands on the wheel. But then you open your insurance bill and it's double what your neighbor pays. Why? Because you insist on driving yourself, while he lets the car drive itself. On January 21st, 2026, U.S. insurtech company Lemonade dropped a depth charge into the global financial and automotive industries. They announced that if you enable Tesla's full self-driving system, your insurance premium is cut by 50%. Let that sink in. This isn't just a marketing stunt. It's an AI safety certificate signed by capital markets themselves. It signals that a traditional insurance model, one that's existed for over a century, is starting to collapse. And a data-driven disruption, spilling beyond auto insurance and into robotics and beyond, has officially begun. Today, we're going to break down this alliance between money and algorithms and see how Tesla is using insurance premiums as a lever to pry open a trillion-dollar-old world. The origin of this transformation is actually very simple. It sounds like a regular promotion. If you drive a Tesla and willing to turn on FSD, insurance premium is cut in half. But the subtext behind it is anything but simple. You have to understand this first. Insurance is, by nature, one of the most risk-averse and tight-fisted businesses in the world. Insurance companies don't sell optimism, they sell probability. Actuaries spend their days staring at statistics, calculating whether you'll crash and when. To them, every dollar of discount is profit carved straight out of their own flesh. So here's the real question. If AI weren't actually safer, if FSD were really as unreliable as critics claim, would a company like Lemonade dare to offer a 50% discount? That wouldn't be charity, would be suicide. Which is why this 50% cut is far more than a promotion. It's a heavy, binding financial verdict. It marks the safety of AI driving being validated for the first time, not by Tesla's own slides, not by lab reports, but by the most risk-averse force of all, capital markets, putting real money on the line. Lemonade's CEO put it bluntly. He said, a car with 360-degree vision that never gets tired and reacts in milliseconds is something humans simply cannot compete with. And beyond today's product launch, he made a clear commitment to the Tesla community. As full self-driving software becomes safer, prices will continue to fall. That statement matters because from this moment on, the direction of commercial auto insurance has officially changed. Some people might ask, doesn't Tesla already have its own insurance business? Why does Lemonade matter? The answer is structural. Tesla insurance is highly precise, but in the US, it faces extremely complex state-by-state regulatory barriers. Lemonade, by contrast, is a lightweight, fully digital third-party insurer. Its entry means that the pricing logic of AI outperforming humans has officially entered the mainstream financial system. It breaks geographic barriers. It allows this AI dividend to spread fast. For the first time in human history, capital markets are using real money and real incentives to formally declare one thing. When it comes to driving, humans are no longer the only reliable standard. Now let's talk about how this math actually works. A lot of people hear 50% off and think, sure, it sounds attractive, but Tesla's FSD isn't cheap. It's $99 a month. So isn't this just the same money coming out of your own pocket? But the moment you actually pull out a calculator, that logic completely collapses. In the past, FSD was seen by many as an expensive toy. You paid for novelty. You paid to try something new. But under an insurance policy like Lemonade's, FSD quietly turns into a financial instrument. Let's look at average numbers in the US. A Tesla Model Y typically carries an insurance premium of about $250 per month. If enabling FSD cuts that in half, you save $125 instantly. We already said FSD costs $99 a month. That means you're not just using one of the most advanced autonomous driving systems in the world for free. You're actually netting $26 every single month. Once that equation holds, FSD stops being an optional software upgrade and becomes a cost-saving tool. And the psychological impact of that shift is devastating. Before, salespeople had to work hard to convince you how advanced AI was, how powerful the perception algorithms were. You could still hesitate. Now the decision becomes brutally simple. If you don't use FSD, you're paying an extra $125 every month to a traditional insurance company. Loss aversion kicks in hard. Very quickly, FSD moves from an optional feature to a default choice. The decision logic flips. It's no longer, do I want to pay for new technology? It becomes, if I don't give up the steering wheel, I'm losing money. And there's something even deeper happening here. This pricing model is quietly redefining what driving means. In the past, driving represented freedom. For many people, it was even a pleasure. But under this kind of precise financial leverage, manual driving starts to look like an expensive, bad habit. No different from smokers paying higher health insurance premiums. In the future, the moment your hands are on the wheel, you become, in the insurer's actuarial models, a volatile risk source waiting to lose control. And this is where the Tesla Lemonade partnership is truly brilliant. They don't sell you emotion and dreams. They go straight for your wallet, using the most basic, earthly logic of money to execute what may be the largest transfer of driving rights in human history. There's one person we can't avoid: Warren Buffett. Through Berkshire Hathaway, he owns an insurance giant, GEICO, the government employees insurance company, the second largest auto insurer in the United States. Buffett has repeatedly said at shareholder meetings that the insurance industry's moat comes from two things: extremely low customer acquisition costs and precise pricing based on historical data. But Elon Musk is draining that moat, using a form of dimensionality reduction, attacking the system from an entirely different layer. Let's look at how traditional insurance pricing actually works. They price you based on labels. If you're in your 20s, single, and living in a neighborhood with higher crime rates, then, sorry, no matter how smoothly you drive, your premium is going to be painfully high. Because in the actuarial models of these legacy giants, the group you belong to is classified as high risk. This is fuzzy, backward-looking macro-level statistics. Put simply, they use large sample probabilities to guess your individual risk. Tesla is playing a completely different game. It's called real-time behavior-based pricing. Tesla doesn't care who you are. How old you are doesn't matter. What matters is how you're driving right now. As long as your car is on the road, Tesla's safety score system watches you like a tireless exam proctor. Did you brake too hard today? Did you slow down properly in a turn? Were you following the car ahead too closely? Even if you get distracted by your phone and the driver assist system forces a disengagement, that gets recorded. This is on a completely different level from traditional insurers sticking a black box in your car that can barely count how many times you hit the brakes. Tesla uses a full suite of cameras and sensors to conduct something close to a God's eye view of risk monitoring. And here's where it gets really interesting. The moment you hand driving authority over to FSD, your safety score is almost guaranteed to max out. Because AI doesn't rush yellow lights to save time. It doesn't drive aggressively after arguing with its spouse. Every single driving action it takes is optimized for the path that maximizes insurance discounts. And that creates a very subtle, very powerful dynamic. Buffett once publicly mocked Tesla's move into insurance, calling it child's play, kids messing with sand, something that could never shake a century-old foundation. But now, when a digital insurer like Lemonade takes Tesla's data and slashes premiums by 50% overnight, that mockery turns into a real, tangible threat. Because this is no longer a competition between two companies. It's a collision between two civilizations. On one side, 100 years of probability theory built on the assumption that humans will make mistakes. On the other, real-time algorithms built on the idea that data can prevent mistakes. When data becomes precise enough and response times fast enough, those moats built on thick historical reports may start to look less like fortresses and more like sandcastles, collapsing at the first wave. And understand this, with one clean cut, halving premiums, Lemonade isn't just causing customer churn for traditional insurers. It's triggering a death spiral with no easy exit. At its core, insurance runs on the law of large numbers, what people casually call mutual aid. Out of 100 people paying premiums, 99 don't get into accidents. The money pooled from those 99 pays for the one who does. Which means the single most valuable asset in the entire insurance industry is those 99 safe drivers who never crash. But now, Tesla and Lemonade are doing something far more precise. They're surgically extracting the safest drivers from the crowd. Think about it. Who is most likely to be the first to choose Tesla's FSD and Lemonade's insurance? People who are comfortable with technology, who already care deeply about driving safety, and who are even willing to accept AI supervision in exchange for lower premiums. And that group just happens to be exactly who traditional insurers value the most. When these safe drivers move in waves toward cheaper digital insurance, the drivers left behind at traditional insurers tend to look very different. People driving older gas cars with no active safety systems, or drivers with more aggressive personalities who refuse to be monitored by AI. The result is obvious. The risk pool at traditional insurance companies deteriorates rapidly. To cover rising losses, they have only one option: raise premiums. And the higher premiums go, the more even halfway decent customers want to leave. What's left is a pool dominated by the highest risk drivers. That's the classic vicious cycle, and it gets even more bleak. If FSD really does reduce accident rates to 1/10 of today's levels, or even lower, society simply won't need as much insurance anymore. For an industry that survives on premium volume, this isn't just shrinking margins. It's the disappearance of the foundation itself. At a deeper level, what's happening here is a massive reallocation of social capital. For the past 100 years, a large portion of our annual transportation budget has gone to insurance companies. That money was essentially buying regret insurance, compensation after accidents happen. In Tesla's worldview, that money should flow to technology companies instead. It should be spent on preventative vaccines, using algorithms to stop accidents before they ever occur. So when insurance costs drop from $250 a month to $125, where does the other $125 go? $99 of it flows directly into Tesla's FSD subscription. Money that once fed insurance giants now becomes recurring revenue and R&D fuel for a technology company. In the future, we may see a strange new social reality. Manually driving could start to resemble an extreme sport, risky and expensive. Insurers may bill you heavily for every minute you spend behind the wheel. And in the used car market, vehicles without FSD could face devastating depreciation, not because they're bad cars, but because the cost of owning them becomes simply too high. If we zoom out even further, you'll realize that FSD insurance discounts are just the tip of the iceberg. What's really hiding underneath is Tesla's ambition in artificial general intelligence and a data-driven dimensionality reduction attack on every potential competitor. We often see Boston Dynamics robots doing backflips and dancing in labs. The hardware looks incredible. So why does the industry increasingly place its bets on Tesla's Optimus robot instead? The answer is the brain. Boston Dynamics robots are largely driven by meticulously choreographed motion control. Tesla's robots, on the other hand, share the same perception and decision-making system as FSD. Tesla has millions of cars on the road worldwide, learning every single day in the real world. How to avoid obstacles, how to interpret human intent, how to handle unexpected situations. This constant feeding of real-world data gives Tesla's AI brain a level of generality that's extremely hard to replicate. And the logic carries over. If FSD's AI is already strong enough to convince insurance companies to cut premiums by 50%, then that same level of safety, stability, and reasoning, when transferred to robots, becomes the most reliable form of productivity imaginable. Now look at autonomous taxis. In Austin and San Francisco, Waymo has already achieved fully driverless operation. But Waymo's model is meticulous and narrow. It relies on high-definition maps and can only operate in tightly defined areas. Tesla's Cybercab takes a different path: pure, general-purpose vision. As FSD insurance discounts spread, Tesla is effectively having millions of car owners around the world pay out of pocket to help it conduct large-scale, real-world testing for robotaxis. So when Cybercab begins mass production at the end of April, it won't be entering a blank market. It will be stepping into a mature one, already conditioned by insurance incentives and deeply hungry for low-cost transportation. Elon Musk has warned that early Cybercab production ramp-up will be slow, even painful. But if Tesla manages to hit annual production of 2 to 4 million units, the disruption facing traditional ride-hailing platforms and taxi companies will be even more brutal than what insurers are experiencing today. At the end of this video, I want to leave you with one thought. What we're witnessing today is really a handoff of how humans define safety. For the past 100 years, our sense of safety was built on compensation. Accidents were inevitable, so we paid into a system that would catch us after things went wrong. Now Tesla and Lemonade are offering a different kind of safety. If technology can make collisions disappear, and if algorithms can compensate for human fatigue and distraction, then maybe that heavy risk tax we've been paying can be transformed into a dividend that actually improves our lives. Look at it from another angle. When AI takes over the boring, repetitive, and sometimes dangerous moments of driving, It's not taking freedom away from us, it's giving it back. You no longer have to force yourself to stay alert on late-night highway drives. You don't have to anxiously pump the brakes during gridlocked morning commutes. Every dollar you save on insurance is, in a way, technology paying respect to your life. Maybe in the future, we'll still miss the feeling of gripping the steering wheel, hearing the engine roar, and enjoying that sense of control. But on most ordinary days, what we really need is a reliable companion that can get us home safely. From paying for regret to paying for peace of mind, this isn't just a shift in numbers on a balance sheet. It's a shift in how humanity chooses to face risk.
Thank you for watching today on the Daily. If this video helpful, even just a little bit, please like, share, and subscribe. On the road to the future, we are strong when we're together. See you in the next episode.